it's going to be a really bad, kind of like an SNL 1980s type crisis. The market probably drops 20 to 30% from here.
The inflation remains high. The central bank is also closely watching turmoil in the banking sector triggered by the collapse of both Silicon Valley Bank and Signature Bank.
Is there a scenario where the Fed could say, we're not going to hike right now, we're pausing?
Financial stability versus price stability. It's a tough one.
To hike or not to hike? The Fed's next move is in question as the bank crisis is feared. The Fed has been very aggressive lately since 1983. We saw Jerome Powell recently saying we need to go faster and hotter and for longer. But things are reshaping domestic and international financial conditions on a daily or even hourly basis. What will be the Fed's decision at the March 22nd meeting? Will the U.S. Federal Reserve pause or continue with 25 basis points? In today's video, Gareth Soloway has shared his prediction for the Fed's next rate hike decision. He has also shared his thoughts on inflation and the ongoing bank crisis. Curious to know more details? Stay tuned until the end of the video. And if you haven't joined our community yet, be sure to subscribe to my channel for more latest updates on economy, crypto, and market. Let's dive into the video now.
So I'm expecting 0 to 25. And again, I think in the next few days, we're going to know whether it's 0 or 25. If things get worse, it's 0. If things calm down, then I think he might do 25. But you had mentioned, too, that the Federal Reserve had telegraphed their rate hikes, right? And it makes it think like, oh, well, how are these banks so dumb to not recognize when he basically said, hey, guys, we're raising X, Y, and Z, so be ready for it. The problem is that in reality, the Fed has almost no trust value, meaning that, where's the credence when, in 2018, they basically reverse ship immediately. They've been basically the drug dealer to the market, just feeding it liquidity constantly over and over again at the littlest issue out there. And so you can't blame people for saying, oh, well, the Fed will just save us if something goes wrong, and starting to believe in that when the Fed has made us believe. And now all of a sudden the Fed's deciding to stand up and cut off the supply. That's my issue there is with the Fed, is that they're not fully trustworthy in what they say over time. So I'm expecting basically 0 to 25 basis points. And again, I would say in between now and that meeting, we're going to know based on if things get worse, it's 0. There's no rate hike. If things calm down, and let's say Europe kind of calms down, Credit Suisse calms down, then I think you're looking at a 25 basis point hike next week. So again, I think that's the angle to take it. And then after that, I honestly don't expect any additional hikes. I think we saw the PPI numbers coming in negative today. That's important to recognize. And again, that's showing us that at least on the producer side, prices are actually starting to drop. And then I think just the action of the instability that this is creating in the financial system, the Fed is going to have to back off and wait and see. They're going to have to take a wait and see approach, which is what they should do. And honestly, they probably should have done a little while.
Powell is adamant that he is not going to make the same mistake as Volcker, who cut interest rates very quickly and inflation returned. With just a few days to go before Federal Reserve policymakers sit down in Washington, exactly what decision they'll make on interest rates now and in coming months has become pretty much everyone's guessing game, especially with the recent economic data and market turmoil. Soloway is expecting rate hikes to be 0 or 25. According to him, the Fed may pause for now and not do any additional rate hikes ahead. Goldman analysts have also commented that they no longer expect Fed rate hikes in March after the SVB failure. To know more details, stay tuned till the end of the video. Also, be sure to give a big thumbs up to this video. Back to economic data. You see, U.S. retail sales and wholesale prices slipped in February. Soloway also commented on how prices are starting to drop on the producer's side. And for now, cooler economic data, including weakening manufacturing conditions, is likely to take some pressure off the Fed to raise rates more rapidly.
When you have interest rates rising this dramatically, right? So we're not just talking about, oh, it's 4 point something on the Fed funds or 5%. We're talking about where it's come from. So it's the velocity of the move that has broken the system. And part of that is the fact that the Federal Reserve basically mismanaged things, right? They said everything was transitory when it came to inflation. They were wrong and had to play catch up. So again, even when we were out of a financial crisis due to COVID, they still said, oh, we're going to still leave it as is, 0 interest rates, essentially free money, because we don't want to rock the boat. Well, the end game is they had to play catch up here, and now you're seeing whether it was Signature Bank or SBNY or even Credit Suisse here. These are some major issues, and that's going to be something that the European Union has to deal with now. This is I've been nibbling on a few different financials, like a little bit of Goldman Sachs, a little bit of JP Morgan, and I've been buying some ETFs that are spread amongst many of the banks out there. And the reason I'm not touching Credit Suisse is much the reason why it was a bad idea to touch SBNY or Silicon Valley Bank is that you're basically putting your money in one asset that we know is already troubled, and we don't know how bad this is going to get. So my recommendation is go with the best of breeds if you're going to nibble small, or go with an ETF that spreads your risk out across the board. But Credit Suisse, this is one of those things. It's like a Lehman moment potentially, where we could wake up one morning and it's shut down, much like we saw with Lehman Brothers. So this is a mess, right? I mean, this is a basic financial crisis 2.0, if you will. And what we're seeing here is Credit Suisse, which already was in a tailspin. And if you look at the chart, right, the daily chart, you have JP Morgan Chase, you had Goldman basically trading near multi-year highs just over the last couple months before this recent collapse, but Credit Suisse was nowhere close to that. It was already in a downtrend. It was already at multi-year lows. So what that was telling us is that smart money knew this was the bank that was going to be in trouble.
Over the past year, the Fed has gone out of its way to signal its intentions on interest rate hikes aimed at quashing hot inflation, relying on a steady stream of economic data inputs to guide its actions. But now, Fed Chair Jerome Powell is in a position to respond in real time to turmoil in the banking system after the collapse of two large regional U.S. banks and Swiss regulators having to pledge assistance to Credit Suisse. Traders now see upcoming days as a toss-up between a smaller quarter-point hike and a pause, with rate cuts seen likely in following months as the turbulence at Credit Suisse renewed fears of a banking crisis that could cripple the U.S. economy. Let's get into the next clip to hear more from Gareth Soloway regarding this matter.
Yeah, so I do think inflation comes back down by end of year. We'll probably be looking at a forward inflation rate of let's say 3.5%, kind of what Larry Fink was saying in his comments this morning. But I think, again, that's a problem because the Fed is not going to be able to cut rates aggressively unless stuff gets so bad. And, we're looking at the regional banks and what's going on in Europe and saying this is really bad. But this isn't even close to as bad as it has to get before the Fed is willing to actually cut rates if inflation is above 2%. And that, I think, is scary to me because, what does it look like if it gets to that point where the Fed actually has to lower interest rates? I would say S&P sub 3,000 at minimum. In fact, per the S&P chart here, that's what I'm expecting. So I'm expecting, again, a little bit of a break lower here. We're obviously seeing downside down to basically the pre-COVID highs, which is right around 3,400. That's first stop. We're about 450 points away from that at this point. And then ultimately, I think by year end, we're at 3,000 or sub 3,000 on the S&P 500. So it's going to get worse. And this is the issue is that, remember, the markets have been conditioned. Investors have been conditioned to say anytime we hit a hardship, anytime we get into a recession, the Fed will bail us out. The problem is we're going to get into a recession in the second half and the Fed's hands are going to be handcuffed. They're not going to be able to bail us out like they have done in the past. So if they actually get to the point of cutting, we are probably in such a catastrophic event in the market system, in the economy, that's why they're doing it. So I'm thinking that you're going to have to see like north of 8% unemployment, maybe 10% before they cut in the next 12 months. And again, I don't know if that unemployment number will happen, but we have to realize that if they start printing money again with inflation at 3.5%, where's the next stop? Is it 15%? Is it 20% before? And so they are realizing this as well. We know that you mentioned this earlier, that Volcker had an issue where he kind of lowered rates too quickly. Jerome Powell says he doesn't want to repeat that. So he's very aware of that issue that could arise. And so he's going to try to hold back as long as possible from cutting, as long as inflation's above that 3% area.
Talking about inflation, recent inflation on the CPI front is cooling, but is still 6%. Inflation indicators remain well above the Fed's long-term 2% target. Still, Soloway is expecting a pause and no more rate hikes for the rest of the year. But is that really what could happen? Analysts also expect the Fed could push ahead with a 25 basis point rate hike in March, despite recent financial market stress and bank failures. So, will the U.S. Federal Reserve pause, raise rates by 50 BPS, or continue with 25 basis points? What are you expecting for the next meeting? Let me know your thoughts in the comments section below. For more latest videos on economy, crypto, and market, be sure to subscribe to my channel. You can also hit that bell icon to never miss any video. Also, don't forget to like and share. I'll see you guys in my next video. Adios, and thanks for watching.